New England, Brisbane, Darwin, Perth, and even Sri Lanka. We decided to host these weekly webinars with people we believe are genuine thought leaders, not just in their area of expertise, but to give you, our clients, in this period of extreme uncertainty, some clarity on an economic and business perspective. Our first speaker this evening is Alan McFarlane from Dundas Partners in Edinburgh. This is the third time I've hosted Alan. The first time was in 2005 or 2006 when he was the Managing Director of Walter Scott, also in Edinburgh, and I was at JB Weir. I also hosted Alan in 2014 through Hamilton Wealth, and Alan was in his current position as Senior Partner of Dundas Partners. Alan is a bottom-up stock picker, but what I've learnt from Alan over the years is that he's a student of markets and also of economies. Who else would recommend to me, and I also read it, The History of Interest Rates. His observations, as you will hear this evening, are insightful as to the effect that businesses are experiencing because the off switch has been hit and we don't know when the on switch is going to be pressed. What, therefore, are the income gaps for businesses as a result of these output gaps, as Hamish Douglas put it? I think there's some scary results will be announced for companies on the first quarter earnings on the revenue front. On a housekeeping matter, we are using Zoom webinar, which has not been hacked like Zoom meetings, but for security purposes, as has been recommended to us, there is a toolbar at the bottom and you'll see there you can post questions, and that's really important, and the only people that can see those are Alan and myself. To ask a question, you simply type your question in, and we'll see your question, and if we don't get to cover it in this webinar, Alan has said that they'll get to answering this in the next 24 hours, and I will pass on your email address to him as long as you don't have an issue on that. Also, part of that is we can't put up visual displays, so I do need to read out a general advice warning, and the reason we can't put it up again is the security issue to do with Zoom. So the information contained in this webinar has been provided as general advice only. The contents have been prepared without taking into account your objectives, financial situation, or your needs. You should, before you make any decisions regarding any information, strategies, or products mentioned in this webinar, consult your advisor to consider whether this is appropriate, having regard to your objectives, financial situation, and needs. So enough from me. I'm now going to hand over to Alan McFarlane, and good morning to you, Alan, in Edinburgh.
Good morning, good afternoon to everybody who's dialed in, and thank you very much, firstly, to you, Will, for this opportunity, which is great, actually, because talking and being obliged to put your thoughts in the clearest way possible is a great help when trying to make good investment decisions. So thank you very much for this. What I'm going to do this morning is address 7 talking points that I made available to Will last night with his approval. If you see me looking a little more odd than usual, I'm running my Bloomberg screen behind this, and there's some charts and data that I might flip to. You won't see it, but it'll just be if I want to give you some facts, then I don't want to be in any doubt. I may go and consult that, but enough with that. 7 points, and the first one is this. If you want to be a successful long-term equity investor, you have to take the oath of optimism. It is the oath of optimism in the sense that your confidence in human ingenuity, productivity, innovation, the competitive forces that economists led by Adam Smith described 220 years ago, those have been outrageously successful ways of bringing wealth and prosperity and a better life to billions of people. And the equity market is not the only way in which you can access that, but it's one of the most important ways. And the oath of optimism, the only reason it's an oath as opposed to a mere turn of mind is that we know that there will be very difficult times, and this is one of them. And preserving that optimism and preserving the discipline of optimism is essential. So you're hearing from an optimist this morning. An optimist, not so much by DNA, but by determination, by the evidence of history and the evidence of experience. How does optimism help us just now? Well, it helps us because it makes us do the right things. It makes us gather the facts. It makes us think clearly. And it makes us act upon sound principles that have been through the mesh of experience up to now. Now that's the background. That is how we are approaching this. It's how we approach things in 2012 all the way through to 2019, and continue to approach them every day. Second talking point is, however, that oath of optimism applies not to markets, but it applies to the businesses that we invest in. It's a very easy linguistic trap or verbal trap to fall into, to presume that the word markets is exactly the same as all the businesses that make it up. Well, if you're an index investor, that may be true, but for the rest of us, that's not the case. We are investing in businesses. We could invest this morning in Rolls-Royce here in the UK that makes aero engines, or rather at the moment isn't making aero engines. Or we could invest in Roche, which is one of the world's biggest biotech and pharma groups that's working 24 hours around the clock. Those are two very different things, but when put in the European index or the world market index, it can get a bit lost, but it's businesses that generate wealth, not share price movements. Share price movements are the result. They are not the thing in itself. Timing markets, trading markets, I actually have nothing to say about that because I've never done it. It's not been my career. I don't say that in a holier than thou way, but I just see precious few people who pull it off repeatedly and persistently, whereas investing in great businesses is a much surer path to success. Equity capital is risk capital. You're the last creditor in a company on its insolvency or its winding up. And sometimes that's also forgotten. And right now, equity investors are bearing the risk, the financial risk of the implications of COVID-19. So that is exactly what we're dealing with. So we need to think clearly about that and think clearly about how we're going to respond to it. The third point is that wealth is created by exchange. The exchange of goods and services for money or other goods and services. That's the wealth generating act. Monetary policy isn't wealth generating. Monetary policy, whether for most of us who've lived through this great decline in interest rates, is the result of a whole range of factors. But monetary policy isn't wealth generating in itself. It may trigger activity over a period of time, but it can't be compared with building a business over a 30 or 40-year period. Lockdown and isolation curtail exchange. That's the recession we're in. It's not like any of the recessions of the last 40 years, the majority of which have been created by bad credit decisions or poor economic management or some other factor that tends to be monetary in its nature. This is an intervention by nature, and governments have decided that the answer is to lock us down. And because we're locked down, you know all the things you can't do, you know all the activities you're not engaged in. That's the cause of the recession. COVID-19 didn't cause the recession. The response to COVID-19 is causing that recession. So how deep is it? Now, this is the tricky part for the oath of optimism amongst those of the believers in the oath of optimism amongst us, because it is necessary to reel off, in this case, a very short list, but a list of what I think are three very powerful facts that are illustrative of the straits that we're in at the moment. So the first one is that the question is, how deep is this recession? IATA, IATA stands for the International Air Travel Association, I'm sorry. And its membership is 82% of the world's passenger and cargo airlines. And you can look at the website later. In fact, I recommend that you do. they are excellent at providing data on immediate and long-term trends in the aviation industry. On the 5th of March, a month ago, on the 5th of March, IATA reckoned, based on data held then, that the airline industry would lose about $60 billion of revenue in 2020 because of COVID-19, which was about 11% of the 29 number. So in other words, the airline industry's recession would be 11%. By the 17th of March, that number had been revised upwards by a factor of 4 to over 250 billion, and a revenue decline of 44%. Now, aviation is one of those industries that has a very clear multiplier effect that we can all understand. So if you don't fly, you don't take a cab or a bus, book a hotel room, shop in the airport, require pilot training, air maintenance, and so on. So that $250+ billion, it seems to us it's perfectly likely that that could double or triple in terms of its effect. And that would be equivalent to about 1% of global GDP. So that's the scale of one industry. The next two facts are equally powerful. As of yesterday, 100 of the 600 biggest stocks in Europe had suspended or cut their dividends, many of them being companies who had never cut their dividends before. Rolls-Royce is one of them. It was privatized by the UK government in 1987 and has never cut its dividend. I didn't put it in, but it's worth mentioning this morning that Jamie Dimon, the chief executive of JP Morgan, which has never passed its dividend and did so and never did in 2007, 2008, he is softening us up for JP Morgan deciding to pass its dividend. And the final one, and this is perhaps the most telling of all, in the week ended 28th March 2009, at the end of the crash. So this was the crash happened in 2007 and 2008. Markets turned in 2009 in February, but March 2009 was the peak month for unemployment claims in America, when 665,000 Americans registered for unemployment in that week. Last week, the week ending 28th March, 6.6 million Americans registered for unemployment claims. So air travel, dividend cuts, unemployment. This is a sharp, bitter recession. And Will didn't mention any of you by name, but indicated that some of you are in the front line of this with your own businesses. And I wish you every success through what we're dealing with. How long will this last? Well, the answer lies with our governments, and they have a very fine judgment to make. Because exchange is restricted by isolation, we need isolation to end for exchange to increase. Now, there's two caveats to that. The first would be that there was some as yet unforeseen change in innovation, so that perhaps Alphabet, Google, or Amazon, or one of the other tech companies radically changed the way that we can exchange and work, effectively extending the present online industry. That's a possibility. And the second one, which I fear is much more likely, is simple disobedience, that people say, up with this, I will not put. And after a couple of weeks of isolation, decide that they're going back to work. And there's signs of that already in some places. But for the majority of us, those of us who quail at getting a parking ticket, we will abide by the law, we will uphold it, and we will stick to what we are being advised to do by the medical people and the government. So this recession isn't waiting for the invisible hand. This recession isn't waiting for any of those things. It's waiting for a change in policy. Point 6, surely government and central bank intervention will fix this and stimulate markets as they did after the dot-com boom, which is 20 years ago now, and after the GFC. Arguably, monetary policy was quite successful in 1987, less so in 94. We need to go back to 1979 when we had, I think, conditions that in any way could be remotely analogous to this. But that's a fair question, and we've been asked that a lot. You know, won't monetary policy fix it? And I think the school of thought that says every market drop is merely an opportunity for you to demonstrate what a brave person you are because you always buy in the dips. I think some of that is related to the confidence we have built up in the last 2 or 3 decades that central banks can and will ride to the rescue accompanied by fiscal policy. That may happen. I can't rule that. That can't be ruled out, but we're skeptical. And the reason for our skepticism is that the monetary and fiscal policies that have been announced are offsetting the effects of the lockdowns that the governments have imposed. So in 2007 and 2008, the central banks could, in America in particular, and here in the UK with the bank failures we had, the governments were able to ride to the rescue of those who had made bad decisions and who were putting at risk the rest of the economy. This time around, they're not riding to the rescue. They are responding to measures they have themselves imposed. So the way we would describe it is that monetary measures at the moment are palliatives. They are not cures. They simply can't be, because all they're doing is seeking to replace the demand that they have rendered null. Final point. Will mentioned that in our day jobs here at Dundas, we're stock pickers, and in about an hour and 40 minutes time, we'll be getting into a research meeting to discuss a number of companies that are in the portfolio that we have accelerated forward in terms of our regular review, and we may touch on 1 or 2 possible new ideas, but that's mostly for tomorrow. So what are we doing? Well, we're applying the oath of optimism. And the oath of optimism is not a mood, it is a spur to effort. And the effort is research. And that is to find the facts, to gather the facts, to put them in the correct context, to understand what has changed and what has not changed, and to inform your judgment accordingly. Now, what does that mean? Well, it means you're trying to find the right businesses to invest in, not trade shares. Now that's not meant to be pious. It often sounds pious when long-term stock pickers compare and contrast their activities relative to, say, an algo trader in New York. There's not a whiff of that. If that's somebody's skill set and it can be applied in a disciplined and repeatable manner, great. We are minded that what makes great returns is great businesses. And so what we're trying to do through our research is identify them. It's an exercise in recognition. It's not an exercise in computation or devising new ways to view the world. And already, because of COVID-19, in March, we jettisoned 3 businesses from the portfolio. One of them was not doing so well anyway. Another had been doing wonderfully beforehand. And the third one was interesting, but we just felt the wind had gone into its face as opposed to pushing it forward. And so they've gone. However, the silver lining of lower share prices is, of course, that you can buy great businesses when they may be on sale. And so we've bought 3, which we think are, our research tells us, are much more exciting and much more robust. That's critical. Where does optimism at the moment meet things that bring joy? Well, this is one of them, what we're doing right now. We've held Microsoft since we made our first investments in 2011. And we still keep all the original research notes. And on the file that day, there was a rather bleak comment, which was, well, the PC may be over, the mobile phone may be coming along, Microsoft has done well with games and so on, but the core business of Windows and MS-DOS is quite mature, but we think there's value in it, and it was a really cheap stock at that time, and so we bought it. Since then, on the way through, believe it or not, Microsoft bought Nokia, which was almost bust at the time, and then they had to sell it. It was a ridiculous decision. But they also bought LinkedIn, and they got a new chief executive, a chap called Satya Nadella, an Indian immigrant, into the USA. The main drivers of Microsoft today are LinkedIn, Office 365 as a subscription instead of those silly discs they used to send you. And in our last research note on Microsoft, with all the genius we could muster, we managed not to mention Microsoft Teams, which is the equivalent within Microsoft of Zoom, which we're using just now. That's how great businesses change and adapt. And so, having held Microsoft for 9 years, we think with the advent of 365, of LinkedIn, of Teams, of video conferencing and so on, the future could be brighter than the decade that we are very pleased to have participated in. The digital economy, I have to say, is coming through this with flying colors. It's not perfect, but it has proven robust, it has proven capable, and it has proven adaptable. So the oath of optimism is not a starry-eyed, it will all be all right, because markets have fallen, they must rise again tomorrow. Away with that. The oath of optimism is about staying the course, staying invested, and being willing to adapt your portfolio. As Mr. Keynes said, when the facts change, I change my opinions. And with that, I'll close and look forward to any questions you would like to bring.
Alan, thank you. That was fantastic. Very much appreciated. We already have one question up. Stuart Wills, when we do these in front of people in person, is always the first person to put his hand up, and he's the first to ask a question. So to what extent do you expect consumer behaviour will change as a consequence of the current situation? So you and I discussed this a week ago. It's a good question.
Well, the first thing we noticed in research is, so over the last few years, about 7 years ago, one of the discussions you would have about a company like the Home Depot in America, which is, I know Australians like to think Bunnings is the answer to every problem in life, but the Home Depot got there first. And the question was clicks versus bricks. Well, that question is over. Bricks closed down, clicks keep going. And on our walk on Sunday, on Saturday rather, when my wife and I went out, we walked past the local butcher down the road. We still have a butcher, we have a fishmonger, there's an organic food shop. Every single one of them had a sign in the window saying, we have moved online and we found people to deliver for us. So it would appear that this trend that was seemingly irreversible is now completely unstoppable. So number one, that's not a speculation, that's the facts as we see it today. One of the stocks that we're going to review this week, and I would, obviously there's a few of you on the call, I would just, actually I'm not going to mention the name, forgive me, because it just keeps all of us safe, and I'm not going to do that. So there's a stock in America that's deeply, deeply involved in discount retail. And what they do is they get surplus material, they buy it when it hasn't sold in Ralph Lauren or somewhere like that, stock it up and sell it for cents on the dollar. And they have a sort of recycling function inside the global clothing and home goods business. Last time we looked at them, one of the things that was remarkable was this particular company, its share price had performed almost as well as Amazon's in the last 5 years without having a single online portal. The entire thing was done by footfall. Now, if we get a recovery, if we stop isolation, and we return to exchange quickly, that company is in a very good place because incomes will be depressed and it sells budget product. And so the case for it will return in a flash. But the judgment we're going to have to make this week is how long is that isolation and what does that do to its balance sheet? Well, we know what it does to its balance sheet. What does it do to its cash flow? And, you know, can it, like a little hamster, can its hibernation be long and deep, but such that it will emerge, or will it not? And so that's a big change. I can share with you what's being speculated. And one of the things, you'll all know this, you'll see it yourselves, but the aviation industry is the one that is I would say it's in the public eye at the moment. And questions about what shape that industry is, how it runs its finances, and how it treats its customers will be a very big thing. But the final one that occurs to me is the data is crystal clear. This will come as a surprise to all of you. I am past my 60th birthday. Don't need to say anything, but so I'm in a notably higher risk group than the rest of the population. But we can look forward to much greater longevity. Questions about insurance and health and conduct. I think that area, so we own some interesting life insurance businesses in the UK and Europe and others that are focused on Asia. It seems likely that the case for them has not weakened. Whether it will increase will depend on consumer behavior. My bet is people will want more of that.
Thank you. Richard's asked, what's the difference between adapting or changing a portfolio, which in a position in a portfolio, due to change facts and share trading?
The answer is turnover, I would say. So another website I would strongly recommend to all of you if you've got a deep interest in this is the Investment Company Institute of America, which is the equivalent of IATA for the mutual fund and ETF industry in the USA. It has data on all the tens of thousands of US mutual funds, fixed income and equity, and reports an Aladdin's cave of data on them. The average mutual fund's turnover rate, by which I mean the speed with which it bought and sold shares, is currently around, I think, about 70 to 80%, which means that by and large, share trading would be investing, what I would call share trading, is investing in businesses with a perspective of about 1.3 years at a time. And many, the algorithmic traders, many of the hedge funds would have much, much higher turnover rates than that. So their skills are in identifying whether UK 10-year bonds are more or less expensive than a UK life insurance company or a German one, or what's the deviation from the euro. And they spot these small differences and they take advantage of them. Or, for example, some of the people who do trading around arbitrage. Long-term investors should be characterized. And by the way, I should say, that group can stay 100% invested in equities, the market, if remaining invested quite short-term in each individual stock. Now, that's the bit I don't get. Because if you buy Microsoft, you want to buy it when it's doing PC and Windows and stay with it until it's doing Microsoft Teams. Or Roche builds a new drug. However, investing in businesses is investing to let that happen. You're investing in a business in order that its future growth in revenues, in gross profits, operating profits, net income, balance sheet expansion, and for us, critically, dividend growth, that all those things keep going and compound at 10% plus, which is wonderfully good for your finances. So why do we sell shares at all? Because we make mistakes or because the facts change. And so our turnover rate last year in the fund that we run on behalf of Australian investors, and I'm invested, my 90% plus of my net worth is invested in its twin sister here in the UK, as are most of my colleagues. we are, our turnover rate last year was about 15% or 17%, which means that on average, we're holding our stocks for 5 years. So that's the difference. Time is the difference. If you're investing for the company's prospects to arrive, as opposed to small differences in valuation, that's how I would characterize the difference between the two approaches.
Carolyn's asked, what is your view of the significance of China post-COVID-19?
Well, China is a fact. 1 point plus, whatever it is, billion people going through what's happened since Deng Xiaoping did his famous tour around the southern states is one of the world historical events. Just as, by the way, the appalling leadership of Mao Zedong was a world historical event in the exact opposite direction. So China is a fact. China is hardwired into our supply chains. I have family in Western Australia that in the good times enjoyed prosperity on the back of the iron ore boom. I think what the question's getting at, if I may read into this, is China's conduct in the early days of the outbreak, the way it mismanaged it, the way it acted subsequently, and its willingness to bluntly push its weight around. And there's even now in parts of the left and parts of the right, actually, in the West, arguing that what we need is a whiff of authoritarianism, and that and the US president persistently makes it clear that he would like to have as much power as Xi Jinping to do what he wants. And there's an argument that authoritarianism is somehow a cure for our ills. There were fellow travelers of some unpleasant people in Germany in the 1930s in the UK, and they're always very keen to tell us that we need more of that and less of how we muddle through. So I think the question of how we deal with China, I can't think of a stock in our portfolio where China is zero influencing it. There's an influence somewhere all the time. So what we need to do is ask ourselves, what system do we believe in? In the last 6 months, China has expelled Western journalists. Personally, I don't know how anybody invests in any of Alibaba, Baidu, or what's the other one? I've forgotten the name of it, Tencent. Every one of those companies listed in the West owns nothing in China. It has contracts with the management teams of their own companies who own all the assets because the Chinese government doesn't let them. So this is an authoritarian, highly successful global player in all of our futures. And so the answer is we deal with things as they are and not as we would wish them to be. The one thing I would say is I am increasingly persuaded of the data that is suggestive that China's workforce has peaked and that the decline in the population and the aging of the population is a problem of growing pressure on that society. But that's true in Italy, that's true in Germany, it's true in the UK, not so true in Australia because of your migration rates, but it's a big problem for them. You may think, you haven't answered anything just now, you just laid out the facts. Exactly, I've laid out the facts. We have flirted with 2 direct holdings in China. Neither of them worked out. And the deep problem was opacity. We couldn't really see what was going on. So currently we're not invested in Chinese stocks, but we are deeply invested in a portfolio that does business with China. And I'll happily come back to that in writing if you'd like more.
Clyde's asked, tech pandemic virus, is this the next Black Swan event? Why not?
A tech pandemic.
Virus, yeah.
Well, I see. Well, the point of the Black Swans, and Mr. Taleb has got a very good video out just now. He's interviewed, I think, by Bloomberg, perhaps by somebody else. So if you look him up, Nicholas Nassim Taleb, who authored The Black Swan, he describes this crisis as a white swan because we've known for some time about the, after SARS and others, the risk of epidemic and potentially pandemic. I think the same applies to the tech industry. We've known about viruses for a long time. We've known about hackers. I don't think any of that is new. So the question would be, and that's not nitpicking. I'm not trying to debate you over the black versus white swan thing. What I'm trying to do is use Taleb's point to illustrate it. His point is black swans are unforeseeable, and the moment they happen, everyone's an instant expert and says, yeah, that was obvious. His point about white swans is that which you know about, if you don't prepare for it, heaven help you. And I think the tech virus is white swan, or the one you mentioned, sir. So what that means is you need to be looking at digital security. We did a bit of a sift on that last year, looked at quite a few companies. We own 2 or 3 just now where digital security is a huge part of the business. One I'll mention because we're not about to review it in the near future is called Akamai, and they host companies' commercial platforms around the world. How does BMW know that what it puts on the website in Munich shows up on the BMW system in Melbourne? And the answer to that is proper hosting and proper control, and Akamai does some of that. So yeah, we're interested in that area. We think it's big, but we think it's a white swan.
Bob's asked, Brexit has not been mentioned in months. How is the UK preparing for the future?
Same way it's prepared for the past. Free country, free exchange, rule of law, 10 of the best universities in the world. The EU, if you've been following it, and this again, it won't cheer you up, but just read some of the debate raging between Italy and the northern European states, the ones who tend to have slightly better fiscal records. There is deep, deep anger in Italy for many of the Eurozone's failings, but 2 things are standing out just now. Number one, there's a clamour from those in fiscal challenge for the development of a Eurobond, which would be jointly and severally guaranteed by all Euro members, for which you can read Holland and Germany. Understandably, the German and the Dutch governments are reluctant to do that. Frau Merkel has made it crystal clear that that is not something she wants to do, which the Italians and others consider to be a complete affront to the European ambitions. At the same time, the same people in Italy are saying, but if we had those Eurobonds, there absolutely cannot be any control over our budgets. So I wish it were white, but if it were white, it better not go black. And so the context of Brexit, I think now more than ever, particularly with the change in the Labour leadership over the weekend here in the UK, we will do a deal with Europe. It will be akin to free trade. We will have blue passports again. And I think in about 2 years' time, we'll wonder what had changed.
Graham's asked a very good question, this one actually. Post this period, how do you see globalization moving forward? I hear a view that countries who have lost their manufacturing industry in the last few decades and are very dependent on the rest of the world may look to protect strategic industries and encourage local manufacturing. If this is the case, what might that mean for investment flows?
That is an excellent question. And in essence, that's an articulate and reasoned way of putting Make America Great Again. That is exactly what Trump argued. And the reason that he beat Clinton was her unwillingness to go and visit the industrial Midwest. Let's leave that aside for 1 second and deal with the facts on the ground. One of the things that we've encountered in the last few years' research is reshoring. So we've seen factories that were effectively were getting shipped to southern China 20 years ago. As wages have grown and manufacturing productivity has improved all around the world, the same systems can be purchased from Japanese manufacturers, German manufacturers, all sorts of manufacturers to do with industrial automation. Those same systems can be bought in any country in the world. And the labor content of manufactured goods, certainly advanced manufactured goods, is declining. And that is a worldwide phenomenon. And so the comparative advantage that China boasted of a highly articulate, educated workforce with a very strong work ethic, which had been suppressed for 50 years or for 40 years for making any money, when that cork came out the bottle and China boomed, and that's now being followed by others. And that part of globalization that the question addresses, namely the integration of global supply chains and the reliance for particular parts on single manufacturers in different parts of the world, that's ebbing already and reshoring. I mean, if you want to run what the Japanese did, the just-in-time inventory models, it's important that your key suppliers are not very far away. And so that is a key factor. So regardless of the point in the question, there was already a move back facilitated by technology and a leveling out of high-end manufacturing wages. On the political point you make, or the economic point you make, I agree with you. I think there will be, I mean, governments now, we've just shut down our long love affair with Margaret Thatcher and Paul Volcker. So the 16% interest rates of 1979 that were put there to suppress inflation, and the Thatcher privatized, let them fail if they go wrong. You know, you could argue the tail end of that. One example of that was that letting Holden and Ford go from Australia. That you could say, well, that's not really Thatcherism, that's just capitalism, and you can't keep propping things up. That's true, but we know what we mean when we talk about Thatcherism and Volckerism. Arguably, that's just finished, because governments in the UK is now paying the wages of millions of people on a 3-month target. Once that has been crossed, then the question about how best do you prop up the economy, I think, has to be a very different question. And that, all I wanted to suggest by the first part of the answer is that might tie in with a very nice trend that was happening anyway. And so I think there is great potential for what you mentioned to happen. In the meantime, Le Pen's and Orban's and Hanson's and Trump's will be shouting it from the rooftops, and we'll have to put up with their rubbish. But unfortunately, that's what we do every day now.
Richard's asked, actually, there's you've covered part of this, but globalization and supranational bodies such as the UN, WHO, EU, etc., have had some bad press. Will the increasing emphasis on the nation state create opportunities?
Well, I'm not yet. I do subscribe to the post-World War II order. I'm a big fan of most of the organizations you just mentioned. I think they do way more good than harm. You take Italy's example there. Italy wasn't complaining about the EU. Italy was complaining that the EU wasn't working in the way that it wanted the EU to work. And so there's if it wasn't for Eurovision, what would Australians watch every year when you send an Australian to the Eurovision Song Contest? So these institutions are incredibly powerful, but there's no doubt that at the moment, there's quite a lot of hunkering down. I mean, this morning, Trump has put pressure on Modi for some of the Indian generic pharmaceutical companies to make available, is it hydrochloroquine? I've apologies if I pronounced that incorrectly. And he's putting the twist on him to get him to ship it, whereas Modi wants to keep it all for India. So that kind of international power. Anyone who doesn't like international arrangements just needs to read their history from the American Declaration of Independence up to 1946. It wasn't our finest 150 years. So cooperation is absolutely essential. The balance is, where are going to be the opportunities with the societies that are open, prize education, provide social safety nets, have a strong venture capital industry, et cetera, that will create new jobs. Governments can do a lot to foster that. And one of my hopes for Brexit Britain is that we do more of that. But we can't, but that hope was a February hope. the UK's debt to GDP ratio was 80% going into this. It's going to blow through 100. So that's going to be tempered by the need for a second round of austerity, because it's, either we deal with this, or we're going to start electing politicians who promise us inflation. And that is the great imponderable. Again, I'm not sure I'm answering your question, sir. I think I'm addressing it. But I'm not ready to give up, and I hope none of us are, on these great global institutions. Reform, yes. Evaporation, no.
We'll make this the last question. But with fiscal spending at extreme levels, are you concerned about sovereign risk, especially in less developed nations? And if so, what will be the impact? What will the impact be on currency and debt markets? You and I also spoke about this the other night, Alan, and you brought in oil, which you haven't touched on, and you were talking about Russia in particular. Yeah.
That is a very good question, as is the second part that you added. So yes, this degree of palliative care is really expensive in the hospital and at home, and it's really expensive in the economy. And the drawback is palliative care spend is directly related to the illness. So this isn't investment spending. This isn't, if you go back to the 1930s and Roosevelt, when he led America out of recession, up to the point of war, it was building bridges, power stations, roads, the highway network, all of that. We're doing none of that just now. We are propping up wages. So it's the humane thing to do, but it's the worst form of fiscal expenditure for long-term benefit. When I say worst, I don't mean that it's intrinsically bad. I just mean of all the choices that were available. So yes, there are sovereign risks. And I think where your point, Will, is really helpful. And thank you for, really genuinely, thank you for bringing it up. We haven't talked about the oil price crisis. There are quite a few oil producers around the world whose budget balances and whose economies don't work under $35 a barrel. Saudi Arabia might just at that level, but Russia doesn't, and Nigeria doesn't. Venezuela certainly doesn't. And so what we have now is already weak economies with serious problems, compromised by the inability to sell the black stuff. They are just examples of what many other countries are seeing. The only thing about the fiscal side, and I always have to get back to this, Japan's done an incredible job with rising deficits or very persistently high deficits, and now a shrinking population. And Japanese interest rates, they can't, Japanese interest rates need Viagra because they just refuse to rise. They are flatlining despite this gigantic rise in debt in Japan over the last few years. So it may be, from an investment standpoint, we have to have some kind of standstill. However, that will be the luxury of the higher GDP per capita societies. And so to go back to the questioner, yes, I think there will be defaults. I'm not a bond manager. I don't do credit. As a firm, we don't do credit. But looking on, rising indebtedness rising indebtedness when exchange is broken and therefore wealth is not being created is a toxic mixture. But, and this is the oath of optimism part, we've been here before. And some clever girl or some clever boy is working in Switzerland just now on that vaccine. And that's what will get us through this. So I am an optimist for that. And I'm an optimist for our portfolio. And I'm an optimist for Will Hamilton's candor in dealing with his clients this way. I don't owe him a thing and he doesn't owe me a thing, but this is the right way to handle your clients. Well done.
Thank you, Alan. Look, thank you also for a fantastic presentation. Look, your insights were invaluable. And thank you everybody also for your questions. We had 8 very good questions there, and I think Alan sort of provided some further depth to in answering those as well. As I mentioned, this is the first of these webinars that we're doing weekly. You'll receive an invitation tomorrow for a webinar on Thursday week with Mark Burgess, the former CEO of the Future Fund. so that he'll be equally as interesting, I'm sure. But look, thank you everyone for attending. Have a great evening, and we'll be in touch. Thank you, Alan, as well.
I'll catch you later, Will. Bye-bye.
Bye-bye.